Market volatility continues. As the countdown to the budget enters the final lap, could the sell-off accelerate or will the sell-off be used to buy? Sanju Verma, the CEO of Violet Arc Global Managers, joins us with her views. Good morning, Sanju. Well, a key event tomorrow. What is the sense you are getting? Should this dip be used to tank up even more? Is the long-term bull market quite clearly intact?
Lata, the fact that this is a long-term sustainable multi-year bull market which should last for at least another 3 to 4 years, if not more, if past precedence is anything to go by. The last multi-year bull market in India being from 2003 to 2008, before that Lehman crash happened and stocks went into a tailspin downwards. If that is anything to go by, we are in for good times, or achhe din, as Narendra Modi would like to say. But should we tank up immediately? I think coming specifically to that query, my sense is that the markets have had a gravity-defying move. And while this sounds very cliched and simplistic, the fact of the matter is that the markets need to digest the steep run-up. The flows have been substantive, though not huge. I think the markets will take a pause, they will take a breather. Don't forget that it's not just the budget tomorrow which will be a catalyst for the market mood and direction going forward, but more importantly you also have the Infosys results this Friday. So I think you have two substantive incremental events which will shape and mold the market move for the next couple of days. I was on your channel less than 2 weeks back when I categorically said that I don't belong to the camp which believes that markets, particularly the Nifty, will cross 8,000 in a pre-budget rally. I said if anything, we will certainly breach 8,000, but that will be a post-budget event. And while I obviously would have loved to see the markets go up and me being proved wrong, the fact of the matter is that the reason I feel vindicated is because I believe that a large part of the rally, 20% plus in dollar terms, calendar year to date, has been a hope rally, call it an aspirational rally, call it a rally based and largely driven by the anticipation of what is to come by. But I think tomorrow will tell us will that come by or not. So I think it's very important to now wait on the fringes. For investors, obviously, it's a strict no-no to participate in the market tomorrow because we've seen that during major events, the Nifty can move anywhere between 200 to 300 points, which is certainly not for the brave, for somebody who's not brave-hearted. But I would specifically think that when it comes to traders, I remember all this while in the last couple of trading sessions, most traders say that, buy both calls and puts at 8,000 strike, and all that you will lose is the option premium. And if there is any volatility, you will make money on both sides, irrespective of whether the markets go up or go down. So you don't really need to trade a bull or a bear market. All that you need to trade is the wicks. You need to trade volatility. I wish it were that simple. And I think yesterday's correction has proven that even traders can get it wrong, because you have not made money just if you've bought 8,000 calls or 8,000 puts. Now I think the strategy for a trader going forward tomorrow, as I said, investors they can sit pretty and wait and watch on the sidelines because there's a lot of headroom for more. But for traders specifically, I think tomorrow if I were one, I would actually buy a bull strangle. I would perhaps buy a 7,800 or an 8,000 call, but I would still go ahead and buy a 7,300 or a 7,400 put because I think the volatility, if indeed it were to come by, could be stiff and could be steep. So if you really want to make money, then go the whole hog and buy a call and a put, buy a strangle with a 300 or a 400 point gap so that you can actually make money both ways. In any case, you're not losing anything but the option premium, but don't go in for a bull straddle, which is a very conservative strategy.
Yep. All right. Sanju, hi, good morning. So that's the trade for traders tomorrow. But what about investors? Since you are very bullish on the markets in the longer term, after the fall we got yesterday, what are the stocks that you would tank up on?
Sonia, I believe that when it's a multi-year bull market, this whole argument of either or between cyclicals and defensives is passé. If you notice, there have been sectoral rotational trends. You've had a steep and a stiff movement in an SBI, high beta like an L&T, but at the same time, look at a Tech Mahindra. I mean, between May end and June end, the stock ran up all the way from 1780 to 2100 plus, which is a 14 to 15% move. That by a tech company, a defensive, is certainly not a defensive move by any stretch of imagination. It screams alpha, it screams beta from the rooftops. So I think it will have to be a very stock specific approach. But that said, I think one sector that comes to my mind and which has led every multi-year bull market rally in India, particularly in the past, that sector is metals. It was beaten down. It was out of investors' radar for a long time. But I think the sector is coming into its own, and I think that can be best corroborated by the fact that analysts who were not willing to buy a Hindalco, when it was trading at less than 5 times EV to EBITDA, saying that it should trade at a discount to the global average of 6.5 or 7 times. Today are saying, because their target prices have been achieved, they are saying, 6.5 times EV to EBITDA, does not do justice to a Hindalco or an Alco. These stocks should trade at, 8 times EV to EBITDA. So the point I'm trying to make is there has been a change in sentiment, and I think in a bull market, as I maintained last time also, while nobody is saying throw out valuations out of the window, the fact of the matter is that valuations are still benign. I will not talk of FY15, because if you're talking of a 1500 or a 1525 rupee EPS for the Sensex, then the Sensex is trading at 17 times 1 year forward, which may not be expensive, but it's not compellingly cheap either. But if you're talking of something like 1800 rupee EPS or slightly more for FY16, then the Sensex is still available to you at barely 14 times, which I think is very attractive. Coming back to metals, be it a Hindalco, be it an Alco, they've had phenomenal runs. I was on your channel about 7 to 8 months back, and I said, Hindalco is one of my top picks in the metal space. The stock has run up 50% plus from there. But at this point in time, if I have to give a specific view, I would say switch out of Hindalco into Nalco. And the reason for sticking to aluminium stocks and to the non-ferrous pack is simply because it is widely believed globally, and rightfully so because of the problems in Indonesia and elsewhere, that after 9 years of being in surplus, perhaps from the later part of this calendar year, aluminium will finally enter into a deficit phase, which means the start of a bull market in aluminium and related ores like alumina or bauxite. And needless to add, Nalco stands to be the biggest beneficiary. I think even in terms of valuations, it looks compelling. If you're talking of a 4 rupee EPS for FY16, the stock of course is available at 14 times PE, but we've never valued Nalco on PE.
Okay.
It's always been a stock that's been valued on EV to EBITDA, and it would still be available to you at just about a little over 5 times.
Okay, Sanju,
so I think that's the call, metals, and specifically within that the non-ferrous pack.
Okay, since you spoke about Tech Mahindra, in any case, Infi numbers on Friday, what are you doing with that stock?
Lata, here it's a bit of an oxymoron. My derivatives and technical team tells me that the stock will run up 300 to 400 rupees more from here. But that's a short-term view. Fundamentally, I particularly don't like Infosys. I think the coming of Vishal Sikka at the helm, I think it's going to not really dramatically change things, because it's going to be a remote control style of management, and for all practical purposes, the noise, the statements that have been coming in the last couple of weeks clearly suggest that the COO on the ground, Mr. Praveen Rao, is actually going to be helming a lot of decision making. Plus, I also believe that the June numbers, which will be out on Friday, will be particularly disappointing. You're not going to see a net profit in excess of maybe 2,600 or 2,650 crores, which would be more than a 10% decline year on year. Remember that last quarter, the fourth quarter of FY14 was particularly disappointing, with Infosys reporting a 1.2% sequential decline in revenues. I think that trajectory will continue. If not a decline, this quarter will continue to see a flat to a sluggish revenue growth. And more importantly, I think the number that investors will be disappointed by is the operating margins that came in the fourth quarter of FY14 at something like 25.5%. I think that will see a 200 to 300 basis point decline driven by rupee appreciation in the last quarter, visa costs and wage increases. So my sense is, Infosys had always given a muted guidance. They said that, we will not do more than 7 to 9% dollar revenue growth in FY15, far below the NASSCOM guidance of 13 to 15%. So I think Infosys will continue to stick to its muted guidance, and anyone expecting fireworks from the management in terms of an optimistic undertone, given the change at the helm of affairs, will clearly be disappointed. So fundamentally, if I have to really be in, a large cap IT company, maybe I would go with the underdog this time for a change, the underdog being Wipro. We are talking of a 38 rupee EPS for FY15, at which the stock at about 550 odd is still available to you at, barely 14 and a half times. And I think this is one of the few IT companies which has refused to budge. It's literally not moved calendar year to date. So I think perhaps some outperformance purely because of the fact that it has, not received a flattering treatment from investors. I think that alone will drive the stock price for the next couple of quarters, if nothing else.
All right, Sanju, we'll have to leave it at that. We've run out of time and the market beckons attention because it started to sell off quite significantly now.